really great to see everyone here. And for today's webinar, I'm here with our speaker, Brad. We'll also wait about 15 to 30 seconds more to allow a few more people to join in. And in the meantime, if you have any questions already or later during the presentation, please type them up in the chat box. If you're here from YouTube, you can type it in the live chat, but if you're here from LinkedIn or Facebook, I would encourage you to join us in Riverside. Okay, one moment. Let me just put our link up here on the screen. Once you join in on Riverside, you'll be able to comment live with us and we'll be able to see your questions live. Okay, and while we wait, Brad, anything you would like to add before we start?
Excuse me. Yes, thank you so much, Leah, for being here with me and everybody else who's joining us out there in social media world as well as here directly. We definitely encourage you to you'll probably have the best experience if you join us here directly instead of trying to live stream it through social media, but totally up to you. And just looking forward to talking about how to break free from Wall Street. It's this is not going to be a Wall Street or other conversation. It's going to kind of be in addition to, but you'll see what we get into here in a few minutes. So looking forward to it. In the meantime, if people can hear that are in here, we have several of you here now. If you could just type into the chat where you're hailing from, maybe just major city or state, that would be appreciative. Also, give us kind of a confirmation that you can actually hear what we're saying. San Clemente, California. Right on. Thank you, Tom. Dallas, Texas. Florida, loud and clear. Thanks, Dan. Yeah, I'll be in Laguna Beach this weekend for a soccer tournament for my son at some elementary school out there. So that'll be fun. Not too far from you, Tom. You may or may not already know we're here in SoCal. But yeah, so let's give it like 30 more seconds, Leah, and then we'll kick this thing off.
Mhm.
Oh, Jeff from Dallas. I think I know which Jeff that is. Thanks, buddy. I'm kind of rolling the dice on knowing whether it's the Jeff I'm thinking of or not. But if it is, good to see you. Appreciate you being here.
All right, we can get started now. Welcome everyone to Solo 401k Break Free from Wall Street. My name is Leah with Sense Financial, and we are a boutique financial firm specializing in self directed retirement accounts with checkbook control. Our presenter today is Brad Sininsky, and I briefly want to introduce Brad. He is a solo 401k and SDIRA consultant here at Sense Financial. He has a professional journey spanning over 18 years in real estate investing. Brad is also a licensed California real estate agent, and his passion lies in empowering people to attain financial independence, affording them the possibility of an early retirement. Again, thank you so much, Brad, for joining us today, and I'll let you take it from here.
All right. Thank you, Leah. Really appreciate it. If you could just confirm that you can see my screen in full and hear me okay, I would appreciate it.
Yes, everything looks all clear.
All right, cool. Well, yeah, as I mentioned, we are going to talk about breaking free from Wall Street. And essentially, what I mean by that is using a self directed account to invest, or at least to have the ability to invest in alternative assets um, in addition to Wall Street. It's not, like I said, it's not an either or, it's a opening the options. And our goal here at Sense Financial is actually to help people take control of and protect their retirement accounts. So that's essentially what we're going to be talking about here. So Leah did tell you a little bit about me. I am a solo 401k self-directed IRA consultant here at Sense Financial, and we're not a fiduciary. This is educational only. We're not here to provide legal, tax, or other accounting or professional advice. So if you need such advice, please seek out the proper professional. We're also not a fiduciary. Okay. Why us? Just real quick. We've been in business since 2010. We have over 5,000 clients now, and we've set up way more than that, different types of self directed accounts over the years. And we have 5-star reviews all over the place. And we help people in all 50 states, people from different walks of life. Many of them are self employed, many of them are not. It just depends. Everyone has their own unique situation. But one thing that is for sure is that they all um, want to, typically, with some exception, but 99.9% of them want to invest in alternative assets outside Wall Street. And that's how they get onto our calendar. So we'll talk more about that in a moment. Good planning and hard work lead to prosperity, says Proverbs 21:5. You work hard for your money, and we want to come alongside you and work hard for you in this sense of providing a self directed account for you. Now, today we're going to focus on the solo 401k. I'll touch briefly on the self directed IRA at the end and some of the differences between that and the solo 401k, but the lion's share of this conversation, this presentation today is going to be on the solo 401k. By the way, if you have questions, please, please, please type them into the chat. Do it immediately. We will give time for Q&A at the end, I promise. And the reason I say do it immediately is because I don't want you to forget what your question is. I may answer it throughout the presentation. If so, that's great. If it's in the chat, I'll hit on it again. That's fine. I'm not going to be upset about that. So type it in with, without hesitancy. So real quick, the difference between the conventional versus self-directed. So think about, and this is kind of a funny diagram here. I used AI to create these images for, but the horse and buggy, if you will, is kind of the conventional side of things, right? It's Vanguard, it's Fidelity, it's T. Rowe Price, it's Schwab, it's Edward Jones, it's your 401k at work, it's it's probably your financial planner, right? It'll get you there eventually, and actually, long term, it's a great strategy. Many people have made millions and millions of dollars in their retirement accounts over the course of time and years, and investing, dollar cost averaging, investing consistently, and just kind of letting it ride, so to speak, right? Reinvesting the dividends, you get that compound interest. Nothing wrong with that, right? We're here to talk about the self directed side of things where you can do that in Wall Street and you can do it outside Wall Street. On the next slide, I'll talk about some of the most common investments that people are doing. But for now, the self-directed side here in this picture is the flying truck, right? I really want one of these, by the way, and maybe it'll look cooler than having two propellers. I'm not really sure, but uh, essentially, I guess it's kind of like a helicopter in the shape of a truck. But the truck can go on the land. This truck it can go on the land. It can go over on the land over, it has a higher clearance, right? So it can go over rocks and through some water and all sorts of different areas, off road, on road, etc., where the horse and buggy can go, right? And beyond. And then in addition to that, I kind of supercharged it with the propellers there so it could go in the air and pretty much go anywhere you want. Now, this is an extreme example because there are some rules, and no doubt if this actual truck existed in real life, there would still be some rules to follow, and that's okay. Um, so I would encourage you to, as we're going through this, just from a paradigm perspective, kind of allow what I'm saying to settle in the sense of, okay, this is not somebody telling me like Wall Street bad, real estate good. That's not what I'm saying at all. I'm saying you have options that you may not even know about until you hear this presentation. So here's some of the most common. And we believe that through self directing and through self directing in a solo 401k or an IRA for that matter provides true diversification. Some of the more common investments are real estate, both commercial and residential, tax deeds, trust deeds. Precious metals, of course, is really common. There's only four: platinum, palladium, gold, and silver, and it has to be certain qualities, and you can't take possession of them. They have to be held in trust with, a third party that's not related to you. And but people do that, right, as kind of a hedge against inflation. So that's an option. Cryptocurrency is getting more and more popular these days, especially with Bitcoin kind of going bananas. So many of our clients are doing that. And then one of the most common or most popular favorite way to invest is actually private lending. Your 401k or IRA can actually become a lender and loan money to just about anybody, as long as it's not your immediate family or you. It can loan money out. It could be a fix and flipper. It could be a A small business that's not publicly traded, startup or beyond, you could provide seed money. I mean, imagine if you could go back and you could say, hey, Uber was just starting out, right? Or Airbnb or Facebook or Twitter, whatever, and you could provide some seed money before they go public. You have the opportunity to do that if you have the eye for keeping an eye out for this. There's tons of companies that are looking for quote unquote angel investors, and that can come from your retirement account or from personal money or whatever. And if you put it in the retirement account, of course, it's tax advantaged, right? Either Roth or traditional pre-tax. So um, the whole idea behind this is being able to invest in what you know, understand, and can control. So most of our clients are already doing this, or at least already have a good idea of what kind of alternative asset they want to invest in. They find out along the way that they can do it inside their retirement account in a tax advantaged situation, and they get on our calendar. Ecclesiastes 11:2 says, divide your portion to seven or even to eight, for you do not know what misfortune may occur on the earth. And that's so true. Diversification is huge. It's really important. And with this, one other kind of paradigm shift I want to give you is if you put money in the S&P 500, you do not control those 500 companies. You don't even control one of them, right? I don't control what Elon does with Tesla. By the way, side note, SpaceX is not publicly traded. So if you can unlock your retirement account through a self-directed IRA, solo 401k, you can actually invest in private equity in SpaceX with the idea that it goes public at some point in the not too distant future and your shares just balloon, right? If you want to stay there, you can move the money and the investments over to a brokerage, or you could liquidate at that point and invest in something else, but it's inside your retirement account. So there's some super cool opportunities with this. But diversification is definitely one of the key aspects of actually self-directing because even in Wall Street, S&P, I keep using the S&P 500 index fund because it's simple. You're spread out over the 500 quote unquote strongest, wealthiest companies in the country, sure, but you don't have any control, and it's not secured by anything. Like, what is it secured by? If the stock falls, like you don't get anything for that. There's no insurance for that that I'm aware of. But with real estate or with a private loan of some sort, you can secure it with something, a hard asset like a single family home or commercial property. Or if you do a business loan, we don't ever recommend, by the way, we don't give financial advice, but I'm going to say this boldly. We don't ever recommend doing an unsecured loan to somebody. Secure it with something, whether it's a vehicle or office equipment or something, right? So that if there's a default situation, there's collateral to foreclose on and make the IRA 401k whole. In fact, you're the fiduciary of your plan when you're self directing. So it's your job to invest wisely, smartly, and aggressively. All right, I'm off my soapbox with that. Avery out of Boise, Idaho is a great example. He is a solo 401k client of ours. And his goal when he came to us about a year ago now was to get control of his retirement, right? Exactly what we've been talking about. He is the founder of a company called J&R Capital LLC, where they are primarily doing hard money loans to fix and flippers. And he's developed quite a robust business loaning to the same several investors, fix and flippers, over and over and over again. And he's generally getting 14% and a couple points up front. Typically, the points are paid up front, and the percent and the principal is the interest in the principal is paid back in a balloon payment in that 6 month term that they generally use. So, very, very cool. He's doing what he does for a business. He's doing for a business that sponsored the solo 401k plan and makes contributions to the solo 401k plan. And also now he's using that expertise to use his 401k money to actually do hard money loans as well. So when I said the whole point of this is to invest in what you know, understand, and control, that's exactly what Avery is doing with his. And hopefully the houses look a little bit better after they're flipped than my little image there. Before, they probably want these type of homes, but he's just doing lending. The property, the 401k is not owning any real estate. It's not managing tenants or managing property managers. He's just loaning and then getting paid when the property is flipped and sold. So there's essentially two different options. checkbook IRA versus solo 401k. All right. Now, the self directed IRA is for anybody. That's why there's like 50 people in that photo, different different looking people, right? Because almost anybody can have an IRA, right? Now, to contribute to an IRA, you must have earned income, but you could have an IRA rollover from a former employer, 401k, and you have an IRA, right? Whether you're actively contributing to it or not. If you're not self employed, the self directed IRA is the way to go. If you have a Roth IRA, and you want to self direct it into alternative assets, the self directed IRA is the only option for you. If you have a traditional IRA, traditional 401k, Roth 401k, and you are self employed, you can have a solo 401k. All right. Now, anybody on the IRA side, self employed individuals without full time W 2 employees outside of the business owners and their spouses is the solo 401k. So, my simple example here is a husband and wife who own a small business together, no employees outside of them too, and they can qualify for solo 401k. So, it's primarily for the solopreneur, hence the name solo. All right. So how does it work? Well, first off, you got to have the plan sponsor, right? You need to have the self-employment activity, like real estate agent, for example. That's the perfect example because 99.9% of real estate agents don't have employees. Okay, typically they're not even an employee themselves. Now, if they get to a point where they're an LLC and filing as S corp, they can be an employee of their own business, but they still qualify for solo 401k. It's when they start hiring full-time W-2 employees that becomes an issue. All right. So if you're a sole proprietor, corporation, S Corp, C Corp, single member LLC, partnership, they all work for solo 401k. All right. So once you determine, hey, I fit that, then and you want to move forward, then the structure is that the plan sponsor, the self-employment quote unquote, adopts the plan. The plan, the 401k, and the trust is created. By the way, the 401k is a trust. So as the plan trustee, which you are the trustee of the plan, like at the plan level, there's no custodian. The the solo 401k trust holds all the assets, the cash, all the accounts, all the investments, etc. So as the trustee, you control it all. Okay, we call this checkbook control. Um, it's different with an IRA. I'll touch on that at the end, but there's no custodian here. So, as the trustee of the 401k plan, you are also the administrator of the plan. You're essentially taking the role of the custodian, Vanguard, Fidelity, Schwab, T. Rowe Price, as examples. You're taking that role and you're also controlling, you're also self directing the assets and controlling all of them. So, we call that checkbook control. With this control, you can open a bank account. So everything you see here on the screen is our setup process. The sponsor is already there. 401k is created, trust is created. You're the trustee. With that power, you open the bank account at a bank, and we help you with this. And then all the income and expenses flow into and out of that account for the investments. Okay, so when you do the initial rollover, the money will simply move into that checking account that is in the name of the solo 401k trust that you control, and you can self direct from there. The whole process takes about a week to set up and maybe about 1 to 2 weeks for the rollover. It really depends on the custodian on the other side of things, where the money's coming from, and how quickly they respond to your request. All right, so one of the other benefits to the solo 401k, and part of the reason we call it the ultimate retirement plan, is that you can invest literally 10 times the amount in the 401k as you can in an IRA. And I'll talk about how those contributions work in a moment. Proverbs 21:20 says, "The wise man saves for the future, but the foolish man spends whatever he gets." I can attest to that from personal experience, by the way. But yeah, when the times are good, we should save because times are not always going to be good, right? And when it comes to retirement planning, of course, you're not always going to be working, most likely, and you're probably not always going to want to be like hustling out there and earning money that you can live on. So if you don't save for your future, It doesn't even have to be a retirement account. It could just be, money, right, in a checking account or whatever. But if you don't save for the future for those rainy days, whether it's an unseen accident that you have to deal with or something that's going to take a bunch of money or just retirement, then, life's going to be difficult. So here's how the contributions work. So up to 23,500 per year plus a $7,500 catch up on the elective deferral side. If you are over 50, you get that catch up. This can be up to 100% of your self employment earnings. Okay. I'll talk about the difference between S Corp, C Corp versus everything else. And then if you are running payroll, like you're an S Corp, C Corp, then the contributions for the elective deferral need to be made pretty quickly, um, typically within 7 days of paying yourself. One of the other benefits to the 401k versus an IRA is that it has pre-tax and Roth. So it has traditional and Roth built into the same plan. Super cool. I'll touch more on that in a moment. And then, so that's the elective deferral. So again, it's pretty much up to 100%. If you're making, if you're an S corp, like a lot of our clients are, then you're running payroll. Okay, the contributions have to be made through the payroll. So whatever the W-2 is, right? So in order to contribute 23,500 for 2025, then your actually, I think that's a typo. I think it's 23,000. No, it is 23.5. Sorry, it was 23,000 for 2024. Excuse me. So 23.5 for 2025. But if you're an S corp, you're running payroll. You got to account for FICA and Medicare. Talk to your tax advisor, but probably you're going to have to run a full W-2 for the year of about 25,000 and maybe some change to be able to contribute 23,500 to the elective deferral. Okay. Now you can't double dip on this. So if you have a W-2 job and you're maxing that out, you're not going to be able to do the elective deferral on the solo 401k. But I want to speak to that for a moment. W-2 group sponsored 401k plans tend to have very high fees, anywhere from a quarter point to over 2%. I mean, there's some crazy high fees on some of these W-2 401k group style 401k plans, not solo 401k. There's no fees like that. So contribute up to the match. If you're self-employed and you're making enough, get the match. That's like free money, right? But once you get the match, consider something else. And again, I'm not here to provide financial advice. This is educational only. Max out your Roth after that. Max out your HSA after that if you have one. HSA is a whole other conversation, but amazing product, by the way. But and then if you're self-employed, contribute the difference in the elective deferral to your solo 401k from your self-employment activity. So hopefully I didn't lose anybody with that, but contribute to the match in your W-2 job, contribute the difference to your solo 401k, max out your Roth, max out your HSA. I'm not necessarily giving you the proper order of this. That's for you to discuss with your tax advisor or your financial planner, but that's kind of my opinion on those things. I digress. The other the way that you get from 23.5 to 70 is because you also have the profit sharing. So if you're S Corp, C Corp, it's 25% of the W-2. If you're sole prop or single member LLC filing as a sole proprietor, then it's 20% of the adjusted earned income. Okay. So those two things will get you up there. Now, if you're maxing out a W-2 401k, you can go from zero all the way up to 70,000 or 77.5 with the profit sharing only. All right, your business just has to make enough to be able to do that, and you can do mega backdoor Roth contributions to get you there as well if you're not making enough for the percentage to get you there. And I'm happy to answer any questions on this because I know I just threw a lot of information out there. So again, the total limits if you're under 50 or 70,000 for 2025. If you're over 50, then you get that $7,500 catch up. And then there's a special super catch up as part of Secure 2.0 that took effect in 2025. If you turn in the years you turn age 60, 61, 62, and 63, you can actually go up to 81,250. And then 24, I have that on there because in some situations it's not too late to actually set up a solo 401k for 2024 and make those contributions. Okay, leverage. So this is also something that is beneficial to the IRA 401k situation outside of the stock market, right? Because other than like margin, I suppose no one's going to give you a loan to buy more, Tesla stock or S&P 500. Um, but in a self-directed account, if you want to buy real estate using that account, if that account wants you want that account to own real estate, you can actually get a loan. You can't provide a personal guarantee, so it must be non-recourse, which just means that the property is the only security. So if there's a default situation, then the property is the only thing they're going after. There's no ding to your credit. Your income is not actually part of it. They will check your credit just to make sure you are who you say you are and you're not a criminal and that sort of thing. But outside of that, it's not a factor. Think of a DSCR loan, um, but with the DSCR loan, you're actually debt service coverage ratio loan. You're actually not. You're actually still guaranteeing the loan as the borrower, even though the property is the only qualifier. With this, it's actually another step. The property is the only qualifier, meaning it's got a cash flow and you need about 6 months of reserves and that sort of thing, just like a regular DSCR loan. But the next step is that you're not providing that personal guarantee. Okay. You can't because you are a disqualified party to your plan, and that would be a prohibited transaction. Now, this will trigger UDFI tax for an IRA. So that's something to bear in mind. We can go down that rabbit hole if someone wants me to. But for solo 401k, it doesn't. And then there's only select lenders that'll do this. So our website there, SenseFinancial.com /non-recourse-lenders will get you to a list of different lenders that actually allow for that. And one of them is a broker, actually, Mark Robbins. So you could start with him and just have him do kind of the heavy lifting for you to find a lender that'll fit your situation. Disallowed investments, it's pretty simple. IRS doesn't tell you what you cannot invest, excuse me, what you can invest in. There's no way to exhaust that list, but they just tell you what you can't invest in. And that is collectibles, baseball cards, stamps, um, uh, what else? Wine, cars, antique cars, antiques, just no collectibles. Okay. And then life insurance in an IRA and disqualified parties. So you and your immediate family, your spouse, your children, their spouses, your parents and grandparents, so kind of like the lineal descents, um, are disqualified to the plan. So you can't invest with them using your IRA 401k. Cannot transact with them. So if your dad owns a property, you can't use your IRA to buy that property. You can't loan your dad money to flip a property or any of these other people. So just keep everything third party and arm's length, and you don't have to worry about this. That's the simplest way to say it. If you have, brother, sister, aunt, uncle, like cousin, that's okay. I don't know if you want to do that just because, maybe mixing family and business isn't the greatest idea, but they're not disqualified. Okay. It's just your immediate family there. Um, so hopefully that makes sense. Here's a quick slide on the differences between the checkbook IRA versus the solo 401k. So the self-directed IRA is not something we offer. All of our plans have checkbook control. So the IRA LLC is the way that we do checkbook control. It's also called a self-directed IRA, but the reason you see two different columns here, one for SDIRA and one for IRA LLC, is because they're different. So a regular basic, however you want to call it, self-directed IRA that does not have checkbook control actually requires you to go through the custodian for all transactions. So there's red tape, there's per asset fees, there's transaction fees, there's time getting to the custodian, all the information they need, the documentation for them to review and execute what you want them to execute. Versus the IRA LLC side or our solo 401k, where you don't have to go through them to do that. You have the power to sign on the dotted line and fill everything out yourself. So it's more efficient. And so that's the difference. That's why that one's there. So I'm going to focus, because we only offer the LLC, IRA LLC, and solo 401k. We can also do an IRA trust as well for people who live in high LLC tax states, like California is $800 a year for an LLC. So we can do a trust instead of the LLC, but same principle here. Um, so they all allow for alternative assets. There's no custodian required for the solo 401k, so we don't, you're the plan administrator. You still have to have one for the IRA. Um, no transaction fees with checkbook control. Of course, if you have a LLC, you'll have whatever fees the state that the LLC is filed in requires. You can do a personal loan in the solo 401k, so you can actually borrow as the 401k owner up to 50% or 50,000, whichever is less, and you can use that for any purpose. And then that's not so with an IRA. There's no loan function in there. And don't misunderstand me. I'm not talking about you using your IRA or 401k to loan to third parties as investing. I'm talking about you personally borrowing money. The max contribution, of course, 8,000 versus 81,250. Built-in Roth, yes, for the 401k, no for the IRA. And then, of course, the major difference is the 401k has that self-employment requirement attached to it. Now, the other part of this is that um, because a lot of our clients they want more Roth money, tax-free ATM withdrawals, right? So the difference is you pay taxes today on the Roth contributions, no taxes at distribution, whereas the traditional funds, you're reducing your taxable income by whatever you contribute. It's growing tax-free, but the distributions are added to your earned income. And traditional funds have required minimum distributions where Roth funds do not. So Roth, there's a lot of advantages to it. You just have to bite the bullet today on taxes. That's the difference. But a lot of our clients want to do what are called Roth conversions. And that's much easier inside the solo 401k plan because it has Roth and traditional built into it. Whereas if you do it with an IRA, you need two separate IRAs to do it, one Roth and one traditional. And you can convert cash or you can convert assets. And so there's a whole strategy behind that I can talk about if someone wants to ask me. But yeah, typically when you convert an asset, it comes in at a lesser valuation. So you can convert that asset to Roth from traditional at a lower taxable amount than if you just convert straight cash or make straight cash Roth contributions. So hopefully that makes sense. Questions. Let's do questions. I think there's some, Leah, in the chat already that we can probably highlight and address, but let's
Yes.
see what they are.
Tom is asking if we can get a copy of the slides.
Oh, yeah, absolutely. So, Tom, we'll send out a recording. I don't know where you're coming in from. If you registered for this, you will automatically get a recording. If you didn't, then send an email to, if I could share my screen again, there we go. Send an email to contact@SenseFinancial.com and we'll send you a copy of the recording. Okay, so it depends on if you're registered, you're going to get it automatically. If not, then contact us and we'll send it to you.
All right, and the second question is from Jeff. For the max 401k distribution, is it the 23.5k I would normally make if I was working as a W 2 employee at a conventional job, but that I am now making contributions as both employee and employer being self employed? I'll show that on stream also.
Yeah. So yes, correct. That is exactly right.
All right, currently that's the questions that we have. If
Okay.
anyone has any further questions, you can type them up.
Did we get another one?
Yes, from Tom. I assume I can place the Solo 401k into a living trust. Is that correct?
That is not correct. You can name a living trust as a beneficiary on the beneficiary designation so that if something happens to you, what the revocable living trust dictates takes over. Typically what our clients do is they name their spouse as the primary beneficiary and the revocable living trust as a secondary beneficiary, but this is a conversation you'd want to have with your estate planning attorney. Oh, we can do that.
Yes.
I see Jeff's question.
Mm-hmm. His question is to explain the rod conversion a bit more, please.
Sure. Yeah, happy to. So there's a few ways to get money into Roth. IRA, 401k, it doesn't matter. Straight Roth contribution, Roth conversion of cash, or Roth conversion of assets. I can't think of any other way. When you contribute cash to a Roth account, whether it's IRA or 401k, that amount that you contribute is remaining on your taxable income for the year, right? So if I contribute $8,000 to an IRA, actually, I'm not 50 yet, $7,000 to an IRA, then I'm still paying taxes today, this tax year, on that $7,000. Okay. 23.5, 31,000, 70,000, it doesn't matter. All that money is being added to your earned income or remaining on your earned income, however you want to look at it, on your 1040. So that's one way to get it in there. There's nothing wrong with that, except for the fact that dollar for dollar in the amount you put in there is you're paying taxes on. Now, let's talk briefly about converting cash or like stocks. Whatever the value of those, whatever the cash amount is going to be added to your taxable income as the conversion. So the difference between a conversion and a contribution is the money's already in the plan, right? You already have $100,000 or whatever it is inside the 401k or the IRA, and you want to flip it to Roth. Well, you can do that, but now you're getting a 1099 for that $100,000. And so you're paying taxes on that $100,000. It's the same thing as a contribution, it's just might be a larger dollar amount. Okay, so that's the second way. The third way is converting a traditional asset to Roth. So let's take um, lending. Let's take a syndication investment. So multifamily syndication, right, where your plan 401k IRA is a limited partner. Now, when you invest in this asset, you cannot just turn around tomorrow and say, I want my money back. You can't just turn around tomorrow and put that investment on the market, so to speak, and sell it and get the money back. So it's an illiquid asset, okay? Because it's illiquid, because you have a lack of control due to the disqualified party, prohibited transaction, locked up in a retirement account aspect of this, there's a whole formula to it. When you get the valuation of the asset from the third party, it's kind of like an appraisal. Because of all those factors I just mentioned, if it's a, let's say, $50,000 syndication principal investment, that valuation, depending on all the circumstances, will come in at a discounted rate, typically 20 to 60% less than the principal investment. So your $50,000 investment may be valued at, I'm going to give a really cool example here, at like 20,000. So now when you do the Roth conversion on that asset, you're getting a 1099 for $20,000 instead of 50. You're paying taxes on 20 instead of 50, but now when you do that conversion, all the returns and all the leftover principal is now Roth. So it's now tax-free forever. That's the benefit of converting the asset instead of just cash or stocks or whatever. Now this won't work for something, it won't work real well for something like a rental property, because rental properties generally appreciate. It might be illiquid, so it's probably not, but it's probably not going to come in as aggressive of a discount or any discount at all, like the example that I just gave. Okay, so hopefully that makes sense, but that's the rabbit hole on the Roth conversion that Jeff, I think you were asking me to get into. What else we got?
All right, I believe that's all of the questions that we have for today. And thank you so much, Brad, for answering all of the questions.
Yeah, for sure. My pleasure. I will, if anybody wants to talk further about their specific situation, you can go to SenseFinancial.com /consultation and book a time on my calendar for a one-on-one, private call. There's no cost to this, and we'll discuss your situation and see if it makes sense for you to become a client of ours. Great. If not, that's cool too. There's no hard selling here, but you're going to walk away with information you didn't have about your situation for sure. So I encourage you to book a call and just ask me some further questions if you're kind of not wanting to broadcast them publicly. That's fine. And then, of course, like I said a few minutes ago, you can contact our office directly at 949-228-9394 or contact at SenseFinancial.com. All right. Thank you, everybody. Really appreciate it. Leah, thank you so much. Appreciate your time.
Thank you so much, everyone. Really great to have you all here. Have a great day.
All right. Take care.